So the topic in this video is the cost of bank loan, which is under the chapter 2C of the management of current liabilities. So in this video I will demonstrate the first two costs of bank loans, that is the line of credit and revolving credit agreement. I will briefly explain what is these two types of bank loans, and also I will demonstrate a simple calculations on these two illustrations or examples. Okay, the first one is line of credit. Line of credit is an informal agreement between a borrower and a bank about the maximum amount of credit the bank will provide the borrower at any one time. There is no legal commitment on the part of the bank to provide the stated credit. It depends on whether the bank has sufficient funds available. Usually require the borrower maintain a minimum balance in the bank through a loan period or a compensating balance of 10 to 20% of the amount borrowed. So this is an example of line of credit for bank loan. SF Berhad recently arranged for a line of credit with CIMB. The terms of agreement called for 100,000 maximum loan with interest set at 1% over prime. In addition, the firm has to maintain a 20% compensating balance in its demand deposit account throughout the year. The prime rate is currently 12%. Required: A. If SF Berhad normally maintains a 20,000 to 30,000 balance in its checking account with CIMB, calculate its effective cost of credit through the line of credit agreement where the maximum loan amount is used for a full year. And B. Recompute the effective cost of credit to SF Berhad if the firm will have to borrow the compensating balance and it borrows the maximum possible under the loan agreement. Again, assume the full amount of loan is outstanding for the whole year. Okay, this is how to answer the questions on line of credit, the illustrations given in the previous slide. Okay, the EAR for situations A, where the company has 20 to 30,000 balance in the account with the bank. So the EAR, as usual, the formula is interest divided by the amount received. And then the interest given in the questions is the prime rate is 12%, but the interest for this type of loan is 1% above the prime rate. So you have to add the 1% from the 12% with the 12%. So 12 plus 1 is 13%. So the interest rate will be the 13% times the amount borrowed of 100,000 is equal to 13,000 over the amount borrowed of 100,000. For this amount received is equal to amount borrowed, because the compensating balance is not going to be deducted from the amount borrowed, since the company has sufficient fund to be taken as the compensating balance. in these questions, the compensating balance is 20% of the amount borrowed of 100,000. Therefore, the compensating balance amount is 20,000, and the company has money about between 20 to 30,000. So the money in the account is sufficient to be the compensating balance for this specific loan. Therefore, the EAR is 13,000 interest over the amount received 100,000. So the EAR is 13%. The situations B, where the company doesn't have money to be accounted as the compensating balance as a requirement of the bank. Therefore, for this type of questions, the amount received will be the amount borrowed minus the compensating balance. Okay, so as usual, the EAR is interest over amount received. The interest is 12 plus 1%, that is 13%, times 100,000, so the interest is 13,000. And then the amount received is equal to amount borrowed minus the compensating balance. Amount borrowed is 100,000 minus the compensating balance of 20% times 100,000, that is 20,000. So the amount received is 80,000. So interest of 13,000 divided by 80,000, so the EAR is 16.25%. If you look at this example, if a borrower doesn't have the compensating balance in the accounts, the EAR will be higher as compared to when a company has some money in the bank and sufficient to be classified as compensating balance for this specific loan. The second type of bank loan is revolving credit agreement. What is a revolving credit agreement? A revolving credit agreement is a formal, committed line of credit extended by a bank or other lending institutions. So it is a guaranteed line of credit where the borrower is assured a specified amount of funds regardless of the scarcity of money. So a commitment fee of around 0.5% is normally charged and applies to the average unused balance of the borrower's credit line. As such, it is more expensive than the line of credit, but less risky from the borrower's perspective. So this is an example of the revolving credit agreement. During the past year, ABA company borrowed on average of 1.5 million under its 2 million revolving credit agreement. As a result, they had to pay 0.5% of the unused balance of 0.5 million. The 0.5 million is the difference between the RCA of 2 million minus the used loan of 1.5 million. So the interest is 2,500. 0.5%. How to get the 2,500? 0.5% times the 0.5 million. In addition, ABA paid interest of 160,000 on the 1.5 million it actually used. So the EAR for this revolving credit agreement is equal to the interest on loan use, that is 160,000, plus the unused balance of 2,500 over the amount received of 1.5 million. So the EAR is 10.83%.